So, kya haal chal, Sat Sri Akal? This is Romit once again. So, today we are going to study ratio analysis ka chapter ka only concept, okay? So, just go for GP ratio. GP ratio is gross profit divided by sales into 100. Net profit, na? So, net profit or EAT you can take into sales. So, if it is after tax, you have to go for that. And if it is before tax, that is EBAT, that is into 100 divided by sales done. Operating profit ratio, that is operating profit divided by sales into 100, or you can take it as EBIT divided by sales into 100. Then go for expense ratio. COGS ratio. What is the COGS? COGS is cost of goods sold. Why am I acting like I'm teaching for LKG students, bro? So COGS is just for COGS divided by sales, okay? Then operating expense ratio, same thing, operating expense divided by sales. And operating ratio is simply COGS plus operating expense divided by sales into 100. So what is operating expense here? Operating expense is just selling and distribution plus any administrative expense. It is operating expense, okay? Financial expense, it is any financial expense given in the question divided by sales into 100, done. And overall return or investment return. Return on asset. So whatever asset you have used in a business, now whatever return you are going to get. The first one is EBIT minus tax. EBIT, whatever you are going to minus tax. You can take it as total assets, you can go for average assets, or you can go for average tangible or fixed assets, okay? Simple. And if you don't have EBIT, then go for net profit or EAT. And if you don't have that, and if you have interest with us, you can go for interest. Yeah, mastala. So net profit plus interest, then go for average total assets or tangible assets, or go for fixed asset. So this is return on assets. Simply asset mein how much you have earned. Next one is return on investment. So whatever you have invested. So when it comes to investment, first remember capital employed. So whatever capital employed, whatever you are going to get. So first one, if it is before tax, EBIT. If it is after tax, EBIT minus tax. So average. Remember to take average. And when it comes to return on shareholders fund, what is shareholders fund? We are going to learn that later, don't worry. Earning after tax. You can also call it as EE, earning available for equity. So that is average, like shareholders, how much you are going to earn. And return on equity. So EAT minus preference dividend, you will get something. So that something you have to divide it by equity shareholders fund. Then here we just assume preference dividend is not there. Profitability ratio. What is EPS? So EAT, EAT minus preference dividend, that is EAE, divided by number of equity shares. This even kids know. Dividend per share, simple. Whatever equity dividend you are going to pay, divided by, like you have earned, like whatever you say 10,000 divided by total number is 500. 500 equity shares are there. This is dividend per share. Dividend payout ratio, simply that is DPS divided by EPS, dividend per share divided by earning per share into 100. You can take it as simple, like 100 minus retention ratio. This is 100. This is also like dividend payout ratio, okay? What is the retention ratio? This is simply in earning per share how much you are paying as dividend divided by EPS. Matlab what? Let us assume you have earned 10 rupees, in that you are going to pay 5 rupees. So the remaining 5 rupees, 6 rupees, the remaining 4 rupees you are going to keep it for yourself. So this is called as retention. So this 4 rupees divided by earning per share, whatever you have earned, 10 into 100, okay? Simple. I've thought it before itself. 100 minus R, that is, okay, 40. 10 minus 4, that is 6. This is dividend payout ratio. PE ratio, simple, market price per share, MPS divided by EPS. Remember this is important. Yield. So when it comes to yield, just close your eyes and write market price, okay? When it comes to yield, just close your eyes and write market price. And when it comes to dividend, just write dividend. When it comes to earning, that is earning per share. Done. Market value by book value. Market value per share divided by book value. Q ratio, this is kind of new. This is simply market value of equity and liability divided by estimated replacement cost of asset. ROCE, return on capital employed. These two are dew point analysis, okay? This guy, Moto guy, he told that operating profit margin whatever you have na, into capital turnover you have to make. In that case you will get capital employed. Okay, capital turnover, capital employed, operating margin. Remember. Then when it comes to equity na, what he told is net profit margin whatever you have na, this is operating, this is net profit margin whatever you have na, add like multiply it by asset turnover, and then equity multiplier he'll give it sims. So after doing this is not that important, okay, both he'll give it sims so that you can find return on equity. This is efficiency ratio. Total asset turnover. So whenever it comes turnover na, whatever it is given like other than this turnover na, put it down. So see, total assets turnover, asset goes down, fixed asset turnover, fixed asset goes down, capital turnover, capital goes down, current asset, current go down. Turnover means sales. So always sales is the king, bro. Why do you run a company? To earn profit you have to sell. So always sale is top divided by average total asset, matlab whatever is given other than that, fixed asset, capital asset or current asset. Working capital turnover ratio is the same thing. Working capital turnover matlab it goes down, that is average working capital, sales goes up. Done. Receivable turnover ratio, simple, but here it is ulta. Here they say net credit sales divided by average account receivable. So why credit sale? Seriously, bro? You are going to take cash sale or what? No. So when it comes to receivable, it is annual net credit sale divided by accounts receivable. And receivable velocity is simple thing. Just have to ulta this, okay? Net credit sale, either it can be average monthly or weekly and the average account payable goes up. This is velocity and this is turnover. Receivable turnover. Why did receivable come down? Oh, it is down only. Turnover is up. Velocity means uska ulta, okay? Turnover ka ulta. Remember that party wala thing. And you can find it in a 3 ways. Simply write 12 months divided by whatever receivable turnover you have na. This you can do, and you can go by this also. Matlab this one, like this one into any rate 365 or 12 or 52. So payable turnover ratio, simple. Turnover is up, sales, payable goes down. Average accounts payable, credit, purchase, turnover, sorry. So this turns. So purchase, bro. Seriously. Purchase, payable, go for purchase. And this is the same logic I've taught you before. Inventory, finished good, turnover. So in case of inventory, first go for COGS. If you don't find it, then go for sales. Done. So turnover. So finished goods is down, up it is sales. So this one is same, just ulta of this. Inventory or WIP turnover. Remember for this. When it comes to WIP, WIP, you have to go for cost of production, okay, divided by same. Turnover goes up, so turnover matlab inventory goes down, and turnover, that is cost of production, goes up. If cost of production is not given, I guess you can go for sales. No, you have to calculate COP and go. And velocity is the same thing. Inventory turnover. So inventory you are always going to calculate based on raw material consumed. So inventory turnover is average inventory goes down and up it is consumed. So remember 3 things. When it comes to finished good, go for COGS. When it comes to WIP, go for cost of production. And when it comes to raw material, go for raw material consumed. And velocity is just the older thing. And this is liquidity, short-term ratios. So current ratio, this even kids know, current asset divided by current liability. Quick or acid or liquid ratio is quick or liquid assets divided by current liabilities. So quick assets or quick liability is simple. Quick assets minus stock, whatever is given, minus prepaid. Okay, remember this. Current assets, quick assets. Okay, quick assets or liquid assets means whatever right now you are going to pay, that one right now you'll get, if you sell you'll get, that is what quick assets. So whatever current assets you have minus all the stock minus all the prepaid thing. So this is just a fictitious one, right? Kind of I guess. So cash ratio or absolute liquid ratio, same. Cash ratio, go for cash divided by liability, whatever you have to pay. Basic defense interval, matlab whatever cash you have divided by cash operating cost मतलब see cash or absolute cash ratio means cash divided by current liabilities. Remember, difference is simply like whatever cash you have now, how much days it's gonna run. So per day you are going to spend 100 rupees, but right now you have 2000 rupees. So right now you have 500 rupees. In that case it goes for 5 days. And net working capital, this is, bro, seriously, current assets divided by current liabilities. But here short term bank borrowing is not there. Okay. Equity ratio, simple, equity fund divided by capital employed. Debt ratio is also same thing. You can go for long term debt or total debt or outstanding divided by capital employed. Debt to equity, simple, debt divided by equity. Debt to total assets, simple, debt divided by total assets. Capital gearing is ratio, this is kind of important. So here you are going to take preference share capital plus debentures plus any other borrowing, okay, divided by equity share capital plus reserves and surplus minus loss. This is just a balance sheet wala thing, bro. Not balance sheet. Understand this, bro. Preference debentures plus any other borrowings divided by equity shares plus reserve minus losses. Proprietary ratio is just owners ka fund. So proprietary fund what you have divided by total assets. Coverage ratio these ratios are for coverage kind of thing. So interest coverage, so how much EBIT is there to cover the interest, okay. And preference dividend, how much EAT is there to cover preference dividend. Equity dividend, how much EAT minus preference dividend is there to cover the equity dividend. When it comes to fixed charge now, what are fixed charge? Like interest you have to pay plus repayment of loan you have to do, EBIT plus depreciation you have to do, okay. Debt service coverage, so here earning available for debt service plus divided by interest plus installment. Remember, I'll tell you once again, I know. Interest coverage is simple, EBIT divided by interest. Preference is EAT divided by preference dividend. And when it comes to equity, na, EAT minus preference dividend you are going to do divided by equity dividend. And fixed charge, na, there are two things, interest and repayment of loan. Here you are going to take depreciation, EBIT plus depreciation divided by interest plus repayment of loan. And debt service coverage ratio is simple, earning available for debt service divided by interest plus installment. So I have told you equity shareholders fund means equity share capital will come, reserves and surplus will come, but only the fictitious assets will be subtracted here. And when it comes to shareholders fund, proprietary fund, net owners fund or net worth, it is simple, whatever you have calculated here, na, this one plus preference share will also come. Shareholders fund mein this will come. In equity share, only equity share plus reserves and surplus will come. In that you have to minus fictitious asset. But when it comes to shareholder fund, everything will come. Matlab preference share will also come. Plus this to pakka it will be there only. So total debt or total outside liabilities include short term and long term debts. Okay. So total assets must be excluding fictitious assets. Fictitious assets means like we'll say, no, I've already paid you, bro. Where did I pay? See, prepaid expenses. Where it is there? I cannot feel it, bro. Oh, it can be intangible asset. No, I'm just kidding, bro. You will study if you go for questions and all. So capital employed. So alternative one, you can go by liability route. So that is by shareholders fund. Remember this, shareholders fund, long-term debt minus any non-trade investment, okay, non-trade investment. And in this side you can go for fixed asset, fixed asset, long-term trade investment and working capital. Working capital is simple, net, what is working capital? Current asset minus current liability, okay, current asset minus current liability. So if you're opting like any figure from P&L and balance sheet, you can go for average if possible. And so sales should be always net of sales return. Matlab if sales is 10 rupees and plus GST is 2 rupees and in that you have returned 5 rupees to the supplier, in that case minus how much it will come? 5, 6, 7, 3. And when it comes to receivable turnover ratio, what we have done before, so in that credit sale net of return including GST will come. Matlab in they are going to same thing whatever you are going to do. Matlab you are going to do return you have to subtract it, and even GST will be taken because in either ways you have to pay it, right? Sorry, you are going to get it, right? And debtors before bad debts and provision for bad debts. So when it comes to receivable turnover ratio, that is sales divided by average receivable, average account receivable. So this average account receivable now, in this when you are taking sales now, you have to take net of return, matlab you have to separate net and return from that, but GST should be there. And when it comes to debtor now, you should not subtract bad debts or provision for bad debts, okay? You have to take it directly. And operating expense, I've told you before, it is operating expense like administrative expense plus selling expense. I know this is better. If you are listening to this, go just listen to this once and just go and solve hundreds of questions for chapters like ratio, working capital, and even the investment. Nothing concept can help you, so you have to practice a lot questions. So in that case you will be pro, bro. Okay, thank you.